on to Unit 14, which deals with share-based payments. So this is a different way that a company might pay for an expense, inventory, or another asset. So quite often we see them as being used as a way of remunerating employees, and that's largely a focus in this unit. So the entity receives goods or services from a supplier. So it could be an external supplier, such as an entity that provides like a fixed asset, and that's how we're paying them with shares, or it could be an employee providing their services. So the standard IFRS 2 deals with two different types of groupings of share-based payments, cash settled and equity settled. So to start with, let's look at cash settled. And this is where an entity acquires goods or services by incurring a liability to transfer cash or other assets to that supplier for amounts that are based on the price of their equity instruments. So here the important things are, we're looking at this type of share-based payment as representing a liability of the entity, and that liability is calculated with reference to the price of their own equity instruments. So what we often see with this are what we call share appreciation rights. So here an employee is entitled to a cash payment in the future based on an increase in the company's share price over a set time frame from a specified level. So if that sort of hurdle is achieved, then the employee can get their bonus cash payment. So it's measured with reference to achieving this sort of increase in the share price. So it's a liability that's recognised and it's remeasured at each reporting date. The trickier share-based payments to understand in Unit 14 are what we call equity settled share-based payments. So this is where an entity receives goods or services as consideration for its own equity instruments. So in other words, that means the entity is paying for goods and services by issuing shares or share options. So the credit side to the transaction is to equity. So here we might have the Ari dog salon, and an employee is being remunerated by way of shares or share options for providing their services. So you'll see within the CSG that an important part to consider when we're dealing with equity settled share-based payments is that we have to consider what we call vesting conditions. So that means it's like a hurdle. So there are things that have to happen before you are entitled to, say, those shares that are in your sort of employment agreement, that you might get them if you do certain things. So that's what we mean by vesting conditions. So on the left here, you can see that there are ones called service conditions, where you just have to stay in employment for a set period of time, and then the shares vest in you, and then you can decide to sell the shares or do whatever you want with them. Whereas where it gets more tricky with the accounting are where we look at what we call performance conditions. And that's where you have to complete a specified period of service again. So again, you might have to stay with the company for 3 years. Plus, you have to meet specified performance targets. So they're split between what we call market conditions. And you'll see there's a graph there. It's all about things that are related to the market price of the entity's equity instruments. So it's things to do with, for example, with their share price. And that impacts the accounting for those equity settled share-based payments, and you'll see what that means about grant date when you explore this unit. On the right, there are conditions called non-market conditions. So that means they're not related to the entity's share price. So it might be about achieving budget. So that's what we call a non-market condition. And again, the accounting for these are a little different to where we're dealing with market conditions. So the best way to understand this unit, just like all the others, is to start practicing and see how you interpret the facts, apply the numbers. So there's quite a number of calculations to do in Unit 14. So this topic links back to Unit 13 with diluted earnings per share, because share-based payments, if you're, you get these extra shares, then you can be entitled to the shares, and therefore that alters your basic earnings per share when you're doing your diluted calculations. Also, there's another complexity to do with share-based payment, where the employee, for example, can choose between whether they want sort of cash or whether they want the shares. So there are some quick reference guides to help you, and the illustrative examples in IFRS 2 are particularly useful. A number of activities and worked examples for you to be looking at, and again, remember that the reading is super important. Hope Unit 14 goes well for you.